Hello everyone. Up to this point, you've learned that prices move constantly, that volatility is normal, and that uncertainty is a permanent part of investing. Now we're going to talk about a concept that often makes those movements feel intimidating, especially for new investors. This concept is known as bear markets. You'll often hear the term used in headlines, during downturns, or in moments of fear. But for many people, a bear market is poorly understood. It's often treated like a disaster rather than a natural phase of investing. In this video, we're going to explain what a bear market is, why it happens, how it affects investors, and how it fits into long-term wealth building. Not just in stocks, but in investing as a whole. Understanding bear markets is essential because avoiding them is impossible. Learning how to think about them is what separates emotional reactions from long-term strategy. So what is a bear market? A bear market is generally defined as a period when prices decline significantly from recent peak points in a stock, typically by 20% or more, and remain depressed for an extended period of time. But the number alone isn't what matters most. A bear market reflects a broad shift in investor sentiment, from optimism to caution or fear. It's not just about falling prices, it's about changing expectations. Bear markets are periods when uncertainty rises, confidence falls, and investors reassess the future. So why is it called a bear market? The term bear market comes from the way a bear attacks, which is by swiping downward. This term isn't technical, it's symbolic. It helps describe the direction and tone of markets rather than the precise mechanics. A bear market signals downward pressure, hesitation, and retreat. It reflects a defensive environment where caution dominates optimism. So what causes a bear market? Bear markets don't happen for a single reason. They emerge from a combination of economic, financial, and psychological factors. Common contributors include economic slowdowns or recessions, rising interest rates, corporate earnings declines, financial system stress, geopolitical events, and loss of investor confidence. Often, it's not one event, but a build-up of concerns that changes expectations about future growth. So how is a bear market different from normal market volatility? Not every market decline is a bear market. Markets experience volatility all the time, which are short-term ups and downs driven by news, emotion, and uncertainty. A bear market is different because it reflects a sustained shift rather than a temporary fluctuation. Volatility is movement. A bear market is a trend. This distinction matters because it shapes how investors respond and how long the environment may last. So how long do bear markets usually last? Bear markets vary in length. Some last months, others last years. What they have in common is uncertainty, not permanence. History shows that bear markets are temporary, even though they can feel overwhelming while they're happening. Markets eventually stabilize, adapt, and recover. The length of a bear market depends on economic recovery, policy responses, corporate adaptation, and investor sentiment shifts. No bear market lasts forever. So why do bear markets feel so intense? Bear markets feel intense because they challenge expectations. During rising markets, confidence builds gradually. During falling markets, fear accelerates quickly. Losses feel heavier than gains feel rewarding. Negative headlines dominate attention. Short-term thinking replaces long-term planning. Bear markets amplify emotion, which is why they're remembered so vividly, even though they represent only part of the investing journey. So how do bear markets affect investor behavior? Bear markets test discipline. Common investor reactions include panic selling, freezing and avoiding decisions, overreacting to news, and abandoning long-term plans. These behaviors are understandable, but they often lock in poor outcomes. Bear markets don't just reveal market risk, they reveal behavioral risk. So are bear markets a sign that investing is falling? The answer is no. Bear markets are not a sign that investing is broken. They are a sign that markets are responding to change. Markets reflect reality, expectations, and uncertainty. When conditions shift, prices adjust. Bear markets are evidence that markets are doing what they're designed to do, which is to process information and reprice assets accordingly. So do all investments experience bear markets? Not all investments experience bear markets at the same time, or in the same way. Different asset classes respond differently to economic conditions. Some decline sharply, others decline modestly, some may even benefit. Bear markets are most commonly discussed in the context of stocks, but periods of sustained decline can occur in other investments as well. So how do long-term investors view bear markets? Long-term investors expect bear markets. They understand that downturns are not interruptions to investing, they are part of the process. Rather than reacting emotionally, long-term investors focus on time horizon, portfolio structure, and long-term goals. Bear markets become periods of patience rather than panic. So why do bear markets create opportunity? Bear markets often create opportunity because prices fall faster than fundamentals change. When fear dominates, assets may be priced more pessimistically than reality justifies. For disciplined investors, this can mean more attractive valuations, better long-term entry points, and higher future return potential. Opportunity doesn't require predicting the bottom. It requires perspective and preparation. So why does trying to avoid bear markets often backfires? Many investors try to avoid bear markets by timing the market, selling before declines and buying back later. This approach sounds logical, but it's extremely difficult to execute consistently. Missing recovery periods can be more damaging than enduring downturns. Avoidance strategies often replace short-term discomfort with long-term underperformance. So how does time reduce the impact of bear markets? Time smooths outcomes. In the short term, bear markets dominate attention. Over longer periods, their impact diminishes as growth resumes. Time allows markets to recover, businesses to adapt, and compounding to continue. This is why long-term horizons are one of the most powerful tools investors have. So how should beginner investors prepare for bear markets? Preparation matters more than prediction. Beginner investors can prepare by understanding that bear markets are normal, aligning investments with time horizon, avoiding emotional decision-making, and maintaining realistic expectations. Preparation turns fear into resilience. So what role does volatility play in bear markets? Volatility typically increases during bear markets. As uncertainty rises, prices fluctuate more aggressively. This can make declines feel chaotic and unpredictable. Understanding volatility helps investors recognize that sharp movements are part of the environment, not signs of failure. Bear markets magnify volatility, but they don't change its purpose. So why are bear markets essential to market health? Bear markets serve a purpose. They correct excess optimism, reset valuations, reallocate capital, and encourage efficiency. Without downturns, markets would become unstable over time. Bear markets are uncomfortable, but they contribute to long-term market sustainability. A bear market is not something to fear, it's something to understand. It represents a period of declining prices, rising uncertainty, and emotional challenge. But it's also a temporary phase in a much longer investing journey. Investing is not a straight line upward. It's a cycle of growth, decline, recovery, and expansion. When investors understand bear markets, they stop reacting to headlines and start focusing on plans. They recognize downturns as part of the process, not the end of it. The ability to remain disciplined during difficult periods is one of the most important skills an investor can develop. Every long-term investor experiences bear markets, and successful investors learn to coexist with them. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.